They changed the rules while you slept. The price didn't crash because sellers flooded the market. It crashed because the exchange flipped a switch. Most people think prices fall when people sell. That's not what happened last night. This is the story of how a rule change became a weapon. By the end of this investigation, you will understand 5 things. First, how margin requirements function as invisible price controls. Second, why raising margins forces liquidation without a single fundamental change. Third, the exact mechanics of the 2011 playbook being used today. Fourth, why this tactic only works on leverage, not physical holders. And fifth, why the failure of this weapon signals the end of an era. This is not financial advice. This is educational analysis of market structure. Let's begin. The futures market operates on leverage. Most people don't realize this. This system allows enormous amounts of capital to move the market with very little cash down. Hedge funds, day traders, and algorithmic systems use this leverage to amplify their bets. When the price moves in your favor, you make outsized gains. When it moves against you, you face outsized losses. The exchange controls the margin requirement. They set the number, and they can change it at any time. For years, this number stayed stable. Traders built positions around it. Algorithms priced risk based on it. The system hummed along. But here's the mechanism most people miss. Well, the margin requirement is not just a rule, it's a lever. And when you pull that lever during a price spike, you don't just shake out weak hands. You engineer forced selling. The beauty of this mechanism, from the exchange's perspective, is that it looks legitimate. They frame it as risk management. They say they're protecting market integrity. But the timing tells the real story. Margin hikes always happen during breakouts, never during crashes. They raise requirements when the price surges upward, claiming volatility risk. But when the price collapses downward with equal violence, the requirements stay flat. This asymmetry reveals the true purpose. The margin hike is not about stability. It's about control. It's about killing momentum before it gets out of hand. It's about protecting the short sellers who bet against the rally and are now bleeding money. Think of it like a casino. The house sets the minimum bet. When a player starts winning big, the house doesn't change the rules for everyone. But in the futures market, they do. When silver starts running, the exchange raises the stakes. Suddenly, the players who are winning find themselves forced to put up more chips or leave the table. Most leave. The rally dies. Let's walk through the mechanics step by step. Imagine you are a hedge fund holding 1,000 silver contracts. Yesterday, your margin requirement was $12,000 per contract. You deposited $12 million in cash. The exchange held it as collateral. Everything was fine. Your positions were profitable. Your risk models showed green. Then, overnight, the CME group issues a notice. Effective immediately, margin requirements are raised to $18,000 per contract. That's a 50% increase. You now need $18 million on deposit. You have 1 hour to wire the additional $6 million. Where do you get $6 million at 2 a.m.? You don't. Your credit lines are maxed. Your treasury desk is closed. Your counterparties are asleep. There's no liquidity available at that hour. So the exchange's computer takes over. It automatically sells your contracts at market price to cover the shortfall. This is not a choice. This is not a negotiation. This is forced liquidation. Now multiply this scenario across hundreds of traders. Suddenly, thousands of contracts hit the market simultaneously. The selling pressure is massive. The price drops, not because fundamentals changed, not because demand disappeared, but because the house changed the buy-in. This is the margin nuke. Historically, this tactic has worked with devastating efficiency. In May 2011, silver was trading near $49.50. The CME raised margins 5 times in 9 days. They hiked the cost of holding a position by 84%. The price collapsed from $49 to $33. Speculators were wiped out. The rally died. It took years for silver to recover. The psychological damage was immense. Traders who survived swore they would never touch silver again. The playbook is identical today. Silver breaks out. The exchange raises margins. Weak hands are forced to sell. The price dips. But here's the detail that changes everything. The margin nuke only kills paper speculators. It does nothing to physical buyers. Tesla doesn't buy silver on margin. The Indian government doesn't buy silver on margin. Industrial users pay cash. When the exchange raises margins, these buyers don't care. They don't get liquidated. They don't panic. This is why today's price action looks different. In 2011, the drop was violent, 10% in a single day. Today, we're down less than 1%. The market is consolidating, not collapsing. The physical bid has replaced the speculative bid. The floor is concrete. Let me show you why this matters. When the 2011 margin hikes happened, the vaults were full. There was no physical shortage. The rally was driven by paper demand, hedge funds buying futures contracts and SLV options. When they killed the paper demand, the price collapsed because there was no underlying scarcity. But in 2025, market observers are discussing a potential 1.1 billion ounce deficit scenario. Refineries are reportedly operating at capacity constraints. Industrial demand from solar and EV sectors continues to grow according to industry reports. The vaults are not overflowing like they were in 2011. You can raise margins on paper contracts all you want. It doesn't create physical metal. It doesn't help Samsung build solar panels. It doesn't put silver back into vault inventory. The margin nuke is a paper weapon used to fight a paper war. But we are potentially in a physical supply situation, and you cannot solve a physical shortage with paper regulations. The fact that the market absorbed this blow is significant. It tells us that the paper market may be becoming less relevant to price discovery. The physical market looked at the margin hike, shrugged, and kept the bid firm. Here's another way to think about it. Imagine a city running out of water. The government responds by raising the price of water futures contracts. Does that create more water? No, it just makes the paper contract more expensive. Meanwhile, people still need a drink. The real price of water, the price you pay at the tap, keeps rising regardless of what the futures market does. That's where we are with silver. The margin hike manipulates the paper price. But the physical price, the price you actually pay to get metal in your hand, barely budged. Let's trace the chain reaction layer by layer. At the top, you have the exchange making the policy decision. They see a breakout, they see open interest climbing, they invoke market stability as the reason. The real reason is counterparty risk. If too many shorts blow up, the clearinghouse is on the hook. The clearinghouse is the central spine of the market. It guarantees every trade. If a major participant defaults, the clearinghouse has to pay. If the clearinghouse can't pay, the system freezes. Next layer down, the prime brokers. These are the banks that finance hedge funds. When the margin hike hits, the prime brokers issue margin calls. Pay up or we liquidate. The hedge fund scrambles. They try to raise cash. But it's the middle of the night. Banks are closed. There's no time. The fund manager calls his credit officer. No answer. He tries to sell other positions to raise cash, but every market is closed. He's trapped. The liquidation begins. The hedge fund's silver contracts are dumped into the market. High-frequency algorithms detect the selling pressure. They front-run the liquidation. They short the market to profit from the forced selling. This accelerates the drop. Now the retail traders see red candles. They panic. Stop-loss orders trigger. More selling. The cascade intensifies. The amateurs who bought the breakout yesterday are now underwater. They didn't understand leverage. They didn't read the fine print. They thought silver was going to the moon. Now they're wiped out. But here's where the script breaks. At the bottom, the industrial buyers are waiting. Samsung sees the dip. Tesla sees the dip. Chinese solar manufacturers see the dip. They don't panic. They buy. They absorb the paper selling. They turn futures contracts into delivery requests. This creates a transfer of ownership from weak hands to strong hands, from speculators who bought with leverage to corporations that need the metal, from tourists to residents, from gamblers to users. The margin nuke cleared out the tourists. The base is now built on physical demand. The next leg up will be sustainable precisely because the weak hands are gone. But there's a second order effect. The banks who engineered the drop are now in a trap. They wanted to force liquidation to cover their short positions cheaply. They succeeded in shaking out the leverage longs, but the industrial buyers absorbed the supply. The shorts didn't cover. The banks are still underwater. Now what? The banks have three options. Option 1, raise margins again. But if they do, they risk triggering a credibility crisis. Traders will stop trusting the exchange. Liquidity will flee to offshore markets. Shanghai and London will become the new price discovery centers. COMEX will become irrelevant. Option 2, position limits. The CFTC could declare that no single entity can hold more than X contracts. This forces large holders to sell down. But again, this only impacts paper. Physical stockpiles are untouched. If you force the whales out of COMEX, they just move to the over-the-counter market. You haven't reduced their exposure, you've just made it invisible. Option 3, liquidation only mode, the nuclear option. They declare that for the next 30 days, you can only sell contracts. You cannot buy new ones. This turns off the buy button. The paper price collapses. But here's the catch. If they turn off the buy button on COMEX, the buyers move to Shanghai. They move to the London over-the-counter market. They move to private vaults. The price decouples. COMEX silver trades at $40 because nobody can buy. Physical silver trades at $90 because everybody wants it. The spread destroys the exchange. No miner will sell to COMEX at $40 when they can sell to Shanghai for $90. The vaults drain to zero. The exchange becomes a zombie market, trading paper ghosts with no metal backing. So the regulators are trapped. If they leave the market alone, the price goes to $100. If they manipulate too hard, they destroy their own casino. This is why today's failure of the margin nuke is critical. It shows they are losing the ability to influence the market without blowing up the system. Let's talk about the psychology of this moment. If you're a short seller who added to your position today, you're now trapped. You sold at $63, $50. The price bounced back to $64 or $9. You're already underwater. Over the weekend, the physical shortage stories will spread. News about halted refineries hits mainstream media. People try to buy online and realize they can't. Panic builds for 48 hours while markets are closed. When Asian markets open on Sunday night, and when US markets open on Monday morning, there will be a rush to get back in. The shorts will panic cover. The sideline money will chase. The FOMO will be intense. We could see a gap up on Monday. We could open at $65 or $66. If we do, it leaves the shorts trapped below with no way to exit without driving the price even higher. This bear trap today was the necessary setup for the next explosive move. It shook out the weak hands. It consolidated the price, and it proved the floor is solid. The path to $70 and then $80 is now clear. Let's translate this mechanism into everyday impact. For the average investor, the margin hike creates volatility but not danger if you own physical metal. Your ounce is still an ounce. The paper games don't touch you. Your wealth is stored in atoms, not contracts. But if you hold leveraged positions, futures contracts, or unallocated ETF shares, you are exposed to forced liquidation risk. The exchange can change the rules mid-game. They can margin you out of a winning position. For industrial users, the margin hike is a gift. It creates artificial dips. Samsung didn't want to pay $65 for silver. Now they can buy it $63. The volatility lowers their input costs. They welcome the chaos. In fact, some procurement managers probably have standing orders. If the COMEX margin hike drops the price below 64, buy 10 million ounces immediately. For the miners, the margin hike is irrelevant to their cash flow, but critical to their stock price. When silver drops on paper, mining stocks drop harder. This is the leverage effect. A 5% drop in silver can cause a 15% drop in a mining stock. But the fundamentals haven't changed. The ore is still in the ground. The cash cost is still $20 per ounce. The dip is a buying opportunity for those who understand the mechanism. For the banks, the margin hike was supposed to be the kill shot. It was supposed to break the rally and allow them to cover shorts at a profit. Instead, it proved the rally is no longer driven by speculation. It's driven by scarcity. This is a wealth transfer mechanism. Forced selling by leveraged speculators transfers metal to industrial buyers at a discount. The speculators lose. The corporations win. The banks remain trapped. The system is fracturing. The paper market is detaching from the physical market. The margin hike exposed the weakness of the paper system. It proved that leverage can be weaponized, but it also proved that physical demand is inelastic. You can manipulate the ticker. You cannot create atoms. Think about the broader implications. For decades, the futures market was the tail that wagged the dog. A small amount of paper trading could move the entire physical market. Refiners hedged based on futures prices. Miners sold forward based on futures prices. The paper market set the tone. But when paper becomes too detached from physical reality, the system breaks. We're watching that break happen in real time. The margin hike should have crashed the market. It didn't. That's not a small detail. That's a paradigm shift. The confidence in the paper pricing mechanism is eroding. When confidence erodes, capital flees. Where does it go? To the thing that cannot be printed, cannot be margined, and cannot be liquidated by an exchange rule change. Physical metal. This creates a feedback loop. The more the exchange manipulates, the more people lose faith in paper. The more they lose faith in paper, the more they buy physical. The more they buy physical, the tighter the supply becomes. The tighter the supply, the more the price has to rise to ration demand. The margin nuke was supposed to stop this loop. It failed. The loop accelerates. Now let's address the elephant in the room. What about the regulatory response? When the price keeps rising despite their best efforts, what's the next move? History gives us clues. In 1980, the Hunt brothers cornered the silver market. The price went to $50. The CFTC responded by instituting Silver Rule 7, which limited positions and implemented liquidation-only trading. The Hunts were forced to sell. The price crashed. Could they do this again? Legally, yes. Politically, it's more complicated. In 1980, it was two billionaires manipulating the market. Today, it's industrial demand from electric vehicles and solar panels. It's sovereign nations stockpiling strategic reserves. You can't accuse Samsung of market manipulation for buying the silver they need to build batteries. But don't underestimate the creativity of desperate regulators. They might invoke national security. They might claim that speculators are threatening the green energy transition. They might propose a windfall profits tax on silver holders. The playbook is always the same. Blame the market, not the policy failures that created the shortage. If and when these measures come, remember the core truth. Regulations cannot create supply. They can only redistribute it. And redistribution always favors the politically connected over the free market. The margin nuke was the bank's best shot. It failed. The price dipped, then bounced. The physical buyers absorbed the paper selling. The floor held at $64. This signals a new phase. The era of easy suppression is over. The physical shortage is now stronger than the paper manipulation. Watch for 3 signals in the next 72 hours. First, does COMEX registered inventory continue to drain despite the price dip? Second, does Shanghai maintain its premium over New York? Third, do mining stocks reverse sharply despite the paper weakness? If all three lights turn green, the next move is vertical. The margin nuke failed, the cage is open. We'll investigate the Shanghai arbitrage trap in the next episode. How the price gap between East and West is draining vaults faster than any bull market ever could. The physics of global arbitrage cannot be stopped by margin hikes. Subscribe to see how the vacuum works.